Welcome to Get Serious, where at Serious Land Capital we funded over $6 million worth of land deals successfully and have industry-leading 41% operating margins. So today I just wanted to give an update on our in-market land deal acquisition strategy that we've been experimenting with probably just under a quarter roughly at this point, and the amount of leads that have started coming in have been much more significant, probably 7 or 8 per day roughly as of the last couple weeks, as we steadily increased the amount of counties that we're going after, as we kind of got comfortable with our system and built it into our workflow. The whole intention of going after these, and I think I might have mentioned this on another podcast, is that, we've gotten a lot more comfortable just underwriting in general. I mean, just put any land deal in front of us, like we will be able to figure it out. Again, I don't think anybody gets more reps than we do when it comes to an underwriting perspective here, backed by natural talent and expertise built over a long period of time in regards to this. And as we want to figure out, bumping revenue and how do we get larger, like inevitably you have to look at some more creative deals that might take a bit longer, possible subdivide or value add plays. And naturally that lends itself to potentially exploring on-market acquisition opportunities, particularly since it's such a low-cost option to consider from an acquisition strategy. And given we are, almost exclusively a funding company, typically our profit margin is going to be more constrained given the profit splits we have built in. So, naturally we have to operate a leaner business to account for reduced margins. If we don't have as large of a marketing budget to go utilize more traditional acquisition methods, then okay, what are the ones that are less expensive to go after? Our expertise still fits in well because we have a significant capital backing to work with. We're very comfortable with our ability to underwrite these type of deals. So that just kind of shares some background on why we wanted to explore this strategy. And we're aware of a few other higher quality operators that have had some success here. And so, we were going into the typical states that, subdividing might be more common in, the Texas and North Carolinas and so forth, just to start. I mean, there's so many more than but it's no surprise to mention that off the bat, where regulations are a bit looser and there's more routinely child parcels that can be sold post Subdivide, just given the demand for that type of land in those markets. We initially started targeting a handful of counties. Okay, we can handle more leads. Let's do more and more and more. And then we were adding, 5 counties a day as we ramped up our process. And, the overall, what fits our criteria might not fit everybody's, but, to start off with, we were like, okay, let's start with minimum 20-acre parcels up to 100. I regret not doing more than 100 off the bat, which I'll get into in a moment here. We did 20 to 100 acres, anticipating, okay, maybe we can get into, because that is a pretty good range for possible minor subdivides, especially if you're trying to do maybe 5 to 10 acre, 15 acre child parcel splits. And then purchase prices between $100K and $1 million. Again, a pretty wide ranging price range to potentially consider, and a large acreage range. And so we just set triggers on Zillow for all these various counties, pretty much just copy pasting that type of criteria. And then we would set it up so that we would get digests of new listings or price cuts of listings that would hit those particular criteria, anticipating that there could be some interesting minor subdivide plays. And again, we would just, within our own team, we would utilize our 5-step subdivide criteria. Again, really, the first 4 are the more important. It's like, okay, determine whether there's child parcels that already exist in the area. You don't want to be the first mover. Next, you want to ensure that there is an active market for child parcels in the area. Subsequently, and typically we're looking for, I wrote about this, but typically, if you're doing a single split, meaning you have one parent parcel trying to split into 2 child parcels, I want to see at least twice as many child parcels that have sold in a period of time compared to parent parcel or acreage within a range, right? It doesn't need to be exact acreage, but roughly for child parcel acreage. And then I want to see, okay, is the child parcel price per acre at least parent parcel acreage on sold comps specifically? Is that achievable? Ideally, you're looking for 2x, right? But the thing with on-market listings is that, you're not always necessarily going to be offering right at 100% of market value. But if you're looking for 2x, of price per acre for child parcels versus parents, then you'd be able to offer whatever the list price is. More often than not, you're not necessarily going to find spread like that in most markets. So it's like if you can get a 1.5 on it, then all of a sudden you only need to offer 75 cents on the dollar for whatever the list price is. Because then you could just build your X margin with that anticipated 1.5x child parcel PPA multiple. So we would look for that, and then looking for the adverse selection. Is it flood zone or different terrain that can really affect the child parcels? The 5th piece of our criteria is you have to know all your costs for the actual subdivide. Not critical to note when you're just assessing but that is a key piece if you're actually going to purchase something. So we were utilizing that strategy and just every single day, again, just getting more and more reps, just looking at these. And it was not the market, at least in those criteria that I mentioned, was far more efficient and stable from a per acre pricing range than anticipated. Like it was very rare, very, very rare to find, almost any type of properties that we could find a 1.5x on the per acre pricing. Like the first couple criteria, it was easier to find. Okay, are there child parcels being sold in the area? Are there, is there greater multiple of child parcel sold comps being sold in a particular area compared to parent parcel acreage? Like those ones we could find more routinely, but the spread on the per acre pricing was far more uncommon. I mean, we're talking on uncommon as in like less than 5% of the time. What was there really opportunity to consider? Or even if there was some opportunity like the parent parcel, it was more adverse in terms of its characteristics compared to some of those child parcels that were being sold, or might require extra work being done and so forth. Like it was difficult to find those out, and we're like, okay, we want to be efficient with our time here. Our that greatest constraint within the business, right, is where you're putting your time in. And if we're not getting like any solid hits here, sure, we're continuing to get better at our underwriting chops and getting these reps in, but what do we have to show for it as far as actually making offers on these deals? And we could make offers on these, but when the per acre pricing is roughly 1x what the anticipated child parcel acreage would be, we'd basically be having to offer 50 cents on the dollar, which for on-market listings that are like just listed, because right, these are usually like, trigger prices for, fresh properties that just hit the market. Sometimes they're going to be price cut properties. And, usually those, there was something going on with them that made us more hesitant for, okay, they're still too far off on pricing. Like we're still going to have to cut in half again. And some folks might say, you should just be making offers and all that. But like we also have to be aware of our own time here, and just I'd be very surprised, especially if somebody's putting the effort into putting a property on market, especially if it's a newer listing. If you get a 50% cash offer from the underlying asset that you have on the market, is just very unlikely to be accepted. That's why, like, okay, maybe 25%. That's why like a 1.5x threshold would potentially make more sense. Like, it might be more palatable to sellers, but like we're not going to spend all day just like sending, you know, 50 cent on the dollar offers there. It's unrealistic for a hit rate. So I was expecting more of a spread throughout this process, that we'd be able to find some more juice that we could squeeze out of these, but it really was not turning out that way. And I reviewed so many of them because we had a bit of a backlog over the holidays. You know, I probably reviewed between 30 and 50 parcels myself today. And it's just like, it was just discouraging as far as, we have to go back to the drawing board here a bit on why is this not working. The experiment here is like, okay, you know, the 20-acre minimum seems to be too small, like in order to figure out spread. And that's the thing, like some folks, they might be saying, well, yeah, you could just chop these up even smaller here. Like, you know, you're going to have to go through a planning and zoning process. Okay, sure. Yeah, you could chop things up into your 20 acres into, you know, 1 to 2 acre parcels here. Usually in a lot of these areas, like it's not necessarily supporting child parcels of that size though. Yeah, if you were looking to do maybe a full-on development, which might be closer to a major subdivide, and then it's usually going to entail, okay, what are the extra utility costs and potentially roads being built in here? Like, I had those options in the back of my mind, but for the most part, for these potential miners that we were anticipating, 20 to 30 acre parcels, parent parcels that might be divided up 2 to 3 to 4 times. It wasn't the underlying market and design of the nearby land was not supporting going significantly less than that. But again, some folks might be saying, yeah, you could have done better there. I didn't see it. So with all that in mind, it's like, okay, the 20 acres probably is too low. Let's just jump up to 50 acres here. Like, we need much larger acreage to potentially find enough spread within the per acre pricing. And again, like I mentioned earlier, you know, we capped ourselves at 100 acres. I'm not sure why. That must have been my decision. It was an error. So now we're just going to remove the max acreage. So now we're willing to consider everything. And now, especially, you know, I'm less concerned about capital constraints. I think we can put together the capital if needed. And so I'm just going to remove that $1 million cap as well too. So that will kind of correlate with going above 100 acres on a number of these properties as well here. And try to start figuring out, okay, what other opportunities do we have? So just to share some behind the scenes on what we are considering at the moment. Yeah, none of this is rocket science, right? Like this, a lot of folks will use similar strategies, or, you know, even off market. What are you kind of targeting? A lot of it's going to be, you know, capital constraints. How much throughput can you actually handle? How many multi-million-dollar deals can any one business handle at once? Usually, it's not many. So we're comfortable sharing what we're going after, just because there's not that many folks pursuing deals of that size anyway, nor do they necessarily have the underwriting chops to figure it out for like best use case and what is truly a deal. So that's always going to be our number one advantage, underwriting over everything. Like that is our core North Star value. So with all of that in mind, hopefully this is helpful for your own land investing journey. None of us have everything figured out. We're certainly not perfect here. So, you know, you can learn from what we've spent our time on the past quarter here and how we're shifting gears. Subscribe and share, everybody, if you've got any deals. Seriousland.capital to submit. $50K minimum purchase price. Take care, everybody. Bye.